Hey, it's Mr. Requetted here, and today we are going to talk about different types of investments and the advantages and disadvantages of each account. Let's begin. Here's the different types of accounts that you have options to invest in. There's different ways to be able to accomplish more or less the same thing with different benefits. And here we'll get into that, starting with mutual funds. Mutual funds is essentially a pool of stocks, bonds, a collection of the market. So say for instance, there's this option to buy $3,000 and you get the whole US stock market straight up. It's just thousands of companies representing the whole stock market. And so what that is, it's a very, very minute fraction of individual companies put into one pool. It's not inherently good or bad, because where it can get kind of sketchy is because it's managed by a broker typically, or an investor. How it works for you specifically is, let's say you put in $3,000 and it's the whole US stock market, right? Like we mentioned before. And it goes up to 5,000. It's been over a course of 20 years or so. It's almost doubled, and you want to cash out, right? So you take out $2,000, which is what you gained from the initial investment. So you're back at $3,000. You're essentially not really cutting off anything. You're not taking out anything. You still have that one mutual fund, because you're just taking a part of the pie that's grown. Although technically you own less of each company, to you it doesn't really matter. The returns are more or less the same, because the market is just consistently about 7 to 10% a year on average for the whole US stock market. It averages out. 1 year ago down 20%, 1 year ago up 10%, 1 year it's going to go up 20 to 30%. But on average, over a course of a 20-year time span, it's going to go up about 7 to 10% for the US as a whole for that specific case. And this is where ETFs kind of come in. That's a much cheaper buy-in. It's essentially the same thing, but you're buying into individual stocks. That each stock is represented as a whole US stock market, but also in each tiny little shares of every individual company, or thousands of them that represent the whole US stock market. So let's say the advantage of that is you can have a much cheaper buy-in. So a Standard & Poor S&P 500, you can just invest in that too, along with the US stock market, and then you can invest in the world stock market, and then you'd have a pretty balanced portfolio there. You can invest that all with $3,000, and you're getting technically more diversification. The only difference is you're taking out an individual stock. It's just not one lump sum. It's a bunch of individual stocks. So what you take out is not necessarily going to leave you with the same share of everything. It should work out to be more or less the same amount over a long run. And with Vanguard, I know that once you reach a certain threshold, it typically will just lump it up into a mutual fund, because those are typically easier to manage, and once you get enough funding in there, it will typically do that automatically. But you'll have to look up what specifically does that. Next, we have a Roth IRA, which is excellent. An excellent idea if you plan on retiring at 59 and a half. You can put in up to $6,000 a year, and so it works kind of like a brokerage account, but it's different. But you can have it work like a mutual fund, you can have it work like an ETF, but you get tax benefits. Now, this is all post-tax income, so as long as you keep it in there, you can just write it out, and when you're 59 and a half, you don't have to pay taxes on it. And you could even take out what you put into it with no penalty. But the only time where you get a penalty is when you take out what you've earned plus the extra income you received, like the gains that you got from that. The important thing is, if you want a Roth IRA, there's plenty of options there. I'd recommend Vanguard. And if you just steadily invest in like something like the S&P 500, US stock market, world stock market, your average contribution, if you put in $6,000 a year, you're going to be very, very well off, because that's all money that's tax-free when you're 59 and a half, and you're just going to be up ahead in the long run. It's almost a no-brainer for those who want to retire at 59 and a half. Next is 401k. Now I just want to start out by making an example here. With either of these accounts, if you were to invest $5,000 consistently over a course of 30 years for a total value of like $150,000, if you were to make regular stock market gains just from those $5,000 contributions, you'd have $750,000 thanks to compound interest. The power of compound interest cannot be understated in this, and I highly recommend doing your own math, doing your own research, but here is like the basic ideas and the basic starting points. So a traditional 401k is you get tax benefits from that. Like you can use it as a tax write-off basically, because you're contributing so much to your 401k. But you'll be taxed when you withdraw the money when you decide to retire. Same rules apply. You have to be 59 and a half. Another disadvantage for a 401k, there will be a 10% penalty if you decide to take out before 59 and a half. There are some rules where you can take out at like 55 and all that, but as a general thing, there is a penalty for taking out early, and you'll have to pay to the IRS for that one. This option is going to be typically a bit more muddy in terms of is it worth it or not. Your employer's typically going to offer it to you, and it's up to you to like do the proper research to decide whether or not it's a good fit for you, because they will partner with different brokerages or try to put it in different like funds that are not necessarily beneficial to you, and you'll need to be careful when you're actually like doing it. The only like main general thing that I would recommend it for is when they do a matching contribution. Like if they will match you 100% just for putting money into a 401k, then I would typically just go ahead and accept that, because that's free money that you get for just contributing to your retirement. If you want to learn more about that one, there's this book called Unshakable by Tony Robbins, who goes into really good detail and really good depth on how this all works with the 401k and how brokerages work and all that. Which brings us to our next topic. A stockbroker is not necessarily your best option. An individual person as a stockbroker makes money off of charging you fees and all that, and it's not you they prioritize. Whether you make a gain or a loss, you have to pay them a certain amount anyways. So it's much better, in my opinion, to just stick with a mutual fund or an ETF, because they really don't know what's going on. They're just going to invest in whatever they feel like is a good idea. They may say like, oh, they'll cherry pick the data, and they will invest in Apple or Samsung, and they'll say that, oh, we made these gains and consistently beat the stock market over 20 years, when really they've actually made a loss typically, or they cherry pick their data. And that's where things get kind of muddy. Past experience does not necessarily show that you're going to beat the markets in the future. That is why it's so much better just to cut the middleman and just join the markets. You do not need to go off from someone else. You save yourself a ton of money, a ton of headache, and a ton of taxes, because whenever they make a trade, which can be on almost a near daily basis, you get taxed for that. You will probably get taxed for that, and they don't necessarily time it right. They don't necessarily do it right. On top of that, there's fees after fees that are just ridiculous. You may be able to like look on their website and it seems reputable, right? It says that like they have an intimate knowledge of the stock market, they know what's going on, so they're experts and trust what they're doing. They will manage your portfolio and all that. But really, no one does. No one can predict what's going on. You can have a deep understanding of an individual business if you do enough research, but you yourself cannot understand what's going to happen tomorrow. You don't know whether it's going to go up or down. Are there people that make legit returns that beat the stock market thanks to a broker, some broker out in who knows where? Sure, but that's less than 1% of people, and that is so statistically unlikely. You can take that bet if you want, but the odds are not necessarily in your favor, and you're better off either doing it yourself or doing it through just sticking to a mutual fund. Hedge funds are more or less the same thing, but for rich people. And they will brag to people about, oh, look at my performance in the past, it's doing so well, it's gaining this and that, and it's so prestigious. But really, it's just kind of like a status thing. I don't really get why people do that. Now, there's nothing wrong with it, but you have to have a certain amount of money for a hedge fund specifically. Look at it this way. If they're taking out fees from like 1% or like a 0.5%, that's a significant amount, because that is 1/7 of like what you've been putting into. And you are already going to lose out on this high amount of compound interest. That is a pretty substantial number to be lost there in fees alone. So you better have, like, if you're going to make a profit, it better be significantly more than what you are losing. Between a 401k and a broker, just be careful, because sometimes with a 401k, the benefits are outweighed by how much money you're actually losing, because some of them will make improper deals with certain companies. They will try to do different things that are just sketchy and questionable, because they are not always out for you. And like we covered, a broker does not necessarily have your best financial interest at heart. This brings us to a brokerage account, which is where you'll typically see most people put their money in. Now, you can invest in Vanguard or Schwab. Those are the two solid places I can recommend. There's a few others like Webull, and I'd be iffy about Robinhood. Like, you can do whatever you want, but I personally do not recommend Robinhood directly, although they are somewhat reputable. They don't have the same backing though as Vanguard or Schwab. But if you want to take that risk, they have a beautiful interface, and I would personally go more for like something like Webull if you want to invest in more of a startup or a more modern brokerage. But Vanguard and Schwab, Vanguard has the lowest rates on an ETF or mutual fund. That will vary depending on what you want to invest in, but typically they are extremely low. They're less than like 0.1%. Like it's gonna be between 0.03 and 0.09, something like that. Do you see what I mean though on why you don't need a broker? because that 0.5% could be building you money that whatever fees they charge and whatever taxes you have to pay is just simply not worth it compared to doing it yourself and potentially doing a brokerage with mutual funds and ETFs. Schwab is also something I would recommend, but I don't know as much about them, so we'll just stick to Vanguard for examples here. So for Vanguard, the 3 ticker symbols that I would recommend that you look out for is VOO, VT, and VTI. There's other types of like bonds that you can look into investing into. There's different types of ETFs and mutual funds that you can look into. But those ticker symbols, VOO, VTI, and VT, are the ones that you're typically going to want to look into, especially if you're young. VOO is the S&P 500. It tracks the S&P 500, which is the Standard & Poor, which is the top 500 largest American companies. So you're looking at the likes of Apple, Facebook, and all that jazz. So you're pretty well set there. What I would recommend is maybe keep it between 10 and 30% of your portfolio if you do decide to invest in it. Then there's VT, which is the whole world stock market, which is a collection of thousands of companies. This one's a bit more volatile, so this one could also be something between 10 and 20%, give enough for diversity and diversifying things, because you don't just want to put all your eggs in one basket, even with these very broad index funds. A VTI is the US stock market, and it's a representative of thousands of companies, and I would recommend about, I don't know, up to like 40 or 60% maybe in your portfolio. Now I say these percentages as like a general guideline. You do it based off your own risk and your own research or whatever you want to do. But if you just want like a clear-cut answer that you can kind of like generally go off of, 40 to 60% is a good metric, and the other percentages I recommended are also a fairly decent metric, because it's all about the risk that you want to have involved. For the US stock market, between 40 and 60%, that's a pretty safe, solid bet, because the US markets always consistently go up over a course of 20 years as a whole. There have been crashes. There have been times where it just goes down, but over a 20-year time span, there has never been reported a loss in gains in the stock market. So over a long term, you should be all right. And then the other two are for diversification, because the S&P 500 is also with the US market, but it's a collection of just 500 companies. It's still gone up, but it's a little bit more of a risk factor, but it's also more of a diversification type of thing, to where if one goes up, another one goes down, and it ultimately averages out. The world market, if the whole world collapses, then you know you're screwed. But as a general thing, it's going to go up. This brings us to taxes. For a typical brokerage account, if you take it out in under a year, you're going to be charged income tax. That's going to vary from state to state, what your income is, and a whole bunch of different factors. But if you hold for under a year, you are going to be charged normal income tax. That is the problem with day trading, because you are taxed the hell out of things, and you are less stable, and you have to pay more taxes to Uncle Sam here. Now, the benefit of over a year, that's capital gains tax. If you're under about $39,375, then you are charged 0% in capital gains tax on the federal level. There might be differences in state level. so do your research on that. But as a general rule, it's 0% for under $39,375, or we'll just say below $40,000, just about, as for short. So over that, you have 15%. You are charged 15% in capital gains tax if you hold your stock for over a year and sell it. So once you surpass $434,550 a year in income, you are charged 20% in capital gains tax. That is a quite steep amount, and odds are if you're watching this video, you're probably between 0 to 15%. Now this can vary, but generally you're going to be charged very low compared to what your income is. And there might be some state tax add-ons. It will vary locally between your state, but as a general rule, you are going to be charged far less if you just hold your money. This is another benefit. So in this video, we have covered both mutual funds and ETFs, which can be applied to any account mentioned here, except for maybe a 401k. That will vary, but generally these will be applicable to where you can put a mutual fund or an ETF into any one of these accounts. Roth IRA is post-tax money that, as long as you just take out when you're 59 and a half, there's no taxes on it. While 401k is, you get tax benefits currently, but after 59 and a half, when you withdraw, you get taxed for it, but you get tax benefits early on. Be careful with a stockbroker and be careful with hedge funds. Be careful with a 401k. They all differ. Generally, the stockbroker and the hedge funds are the bigger evils, while the 401k is dependent on what your company does and what your company's policies are and who they are under. A brokerage account is your average account here. Try looking at VOO, VT, and VTI for starters. You can do whatever industry you think is better. You could look up yourself and do your own research and decide for yourself what is best for you. These are just recommendations and examples. If you hold over a year, it is considered capital gains tax. If you hold under a year, it is considered normal income. Normal income you want to stay away from, and it will cost you more money in the long run. So that wraps up everything, you guys. Please like and subscribe and comment below. What do you think? What are your strategies? I want to know. I want to hear about them. Let us know in the comments.